Welcome to the Dakota Live podcast. I'm your host, Robert Morier. The goal of this podcast is to help you know the people behind the investment decisions. We introduce you to chief investment officers, manager research professionals, sales leaders, and other important players in the industry who will help you sell in between the lines and better understand the investment sales ecosystem. If you're not familiar with Dakota and their Dakota Live content, please check out dakota.com to learn more about their services. Before we get started, I need to read a brief disclosure. This content is provided for informational purposes and should not be relied upon as recommendations or advice about investing in securities. All investments involve risk and may lose money. Dakota does not guarantee the accuracy of any of the information provided by the speaker, who is not affiliated with Dakota. Not a solicitation, testimonial, or an endorsement by Dakota or its affiliates. Nothing herein is intended to indicate approval, support, or a recommendation of the investment advisor or its supervised persons by Dakota. Today's episode is brought to you by Dakota Marketplace. Are you tired of constantly jumping between multiple databases and channels to find the right investment opportunities? Introducing Dakota Marketplace, the comprehensive institutional and intermediary database built by fundraisers for fundraisers. With Dakota Marketplace, you'll have access to all channels and asset classes in one place, saving you time and streamlining your fundraising process. Say goodbye to the frustration of searching through multiple databases and say hello to a seamless and efficient fundraising experience. Sign up now and see the difference Dakota Marketplace can make for you. Visit dakotamarketplace.com today. Well, I am very happy to introduce our audience to Adam Jordan, Director of Investments and Chief Compliance Officer for Paul Ried Financial Group based in Bellevue, Washington. Welcome to Philadelphia.
Thank you. Very nice studio you got here.
Thank you. We like it as well. It's very always great for us to have people come in from outside of the city to sit down and speak with us, about what they do and how they do it. Tim Dolan, as always, it's great to see you.
Good to see you.
Thanks for being here.
Yep.
So before we get started, we have lots of questions to ask you. I'm just going to quickly let people know about Paul Ried Financial Group and your background. So for our audience who may be new to Paul Ried Financial Group, Paul Ried Financial Group specializes in pre- and post-retirement planning for corporate executives, managers, and engineers. The firm integrates investment management, estate strategies, and income design for clients with total advisory assets of approximately $1 billion. As Director of Investments, Adam's responsibilities include developing, implementing, and monitoring client portfolios. This includes designing the overall asset allocation strategies, conducting in-depth market analysis, investment manager due diligence, as well as performing trading activities. Also, as Chief Compliance Officer, Adam carries out supervisory and compliance responsibilities. He joined the firm in 2002. Congratulations on your tenure. Adam earned the Certified Investment Management Analyst designation, which includes an educational component administered through the Wharton School of Business here in Philadelphia. Adam earned the Accredited Asset Management Specialist designation through the College for Financial Planning. He also holds Series 7, 24, 53, 63, and 65 registrations. In addition, Adam is part of the leadership team for the Association of Professional Fund Investors. Adam is a longtime Seattle Seahawks fan and a season ticket holder. He also enjoys traveling. His wife, Tiffany, would say he loves reading boring financial stuff in his free time. Adam, thank you for being here. Congratulations on all your success. It's great to have you in Philadelphia.
Thank you. Thank you. Great to be here.
Well, I'm also guilty of reading the boring financial stuff. So what's been trying not to bore you recently?
I'd say financial markets haven't been boring me recently, but kind of on the way over here, I wasn't reading. I was technically listening to Audible book. So it was a chip war. So it's actually very, very timely, I think, kind of right now with all geopolitical things going on. So that's kind of keeping me interested.
Oh, interesting. Well, we'll definitely talk more about technology and how you're thinking about the markets today. I noticed your company's website had some book recommendations just on that same theme. One of them was Daniel Kahneman's Thinking Fast and Slow. And in the book, there were two systems that he described, kind of the fast twitch, thinking quickly, intuitively, and then the second system, which is the deliberate, kind of logical. So when it comes to financial planning, you're thinking about your clients. You've been with Paul Ried now for over 20 years. Again, congratulations. How do you encourage your clients to engage more with that system two thinking, that slower, more deliberate pace when making these big financial decisions?
Yeah, I think it's definitely important, and I think it comes in on Paul and the team have done a really good job. All the advisors have done a really good job at this. I think starting off the relationship with no investments. So it's not about investments. It's more about the planning. If you start off the relationship talking about the planning and later on you get into the investments, so they'll go through probably 3 meetings with a new client before ever talking about the investment. So I think that really frames the relationship going forward for the years forward, that it's about the plan. So if something's going on in the markets 2 years down the line, you can always bring them back. Remember, we were talking about the plan. We knew that these were possibilities that could happen. This is shorter term, so it gets them away from that day-to-day thinking. And we can kind of tie that into the investments as well, realizing when we structure investments, we don't want to really, we try and give more broader mandates to managers because we don't necessarily want the little sector funds or things that might be, it's more line item risk, I guess you could say. So that kind of triggers their, level one thinking when they're seeing something down 20%. Why is energy down 20% and tech's up? We need to be in tech. It's bringing them to broader mandates so they don't see those smaller pieces.
No, that makes sense. I appreciate that. Well, you mentioned Paul Ried and Paul Ried Financial. Maybe for our audience, can you tell us more about the organization? Maybe set the stage as to what your mission is. We mentioned some of your clients, but what are the day-to-day objectives?
So Paul started the firm in late 80s, 1987, and he had actually, prior to that, he worked for Boeing. So he was working there and decided he just needed to start something new. Went out and began advising. And since he had connections kind of in the Boeing company already, he actually started teaching classes for Boeing, kind of on the retirement plan, how to invest your 401k and that sort of thing. And that kind of snowballed into the fact that he's then start getting clients from Boeing. So really had a specialty in the Boeing area and taught classes all the way up to probably 2006 or 7 when they moved their home office over to Chicago. I believe it's in DC now. Really focused on, from the start, the planning aspect of things. So it was always about, it's planning first and then investments. And so, we have a lot of Boeing engineers. Probably 70% of our clients are probably Boeing related in some way, but we also have tons of people from all the other industries, but mainly focus on more your mass affluent to high net worth. We're not necessarily, working with ultra high net worth clients. It's kind of your person that's been working for 20, 30 years, has built up a really good nest egg, and we're gonna cater these assets for them and help them guide them through the retirement stages. So we also work with primarily only retirees. I mean, we do have some younger generations in there, but it's primarily when you're within 2 years of retirement, we're saying that's kind of the time to come work with us and guide you through, the very complex part of the retirements. The accumulation's one thing, but the whole distribution phase is another.
It sounds like a lot of education. Do you enjoy the educational component of it?
Yeah, I do. And I'm more on the investment side, so they'll bring me in when it's more investment related questions, but being able to always bring things back to the plan and why we're doing this, what are these funds actually for, helps clients stick with the plan.
So once you've gotten through the planning stage, as you think about the investment research, could you describe the core philosophy that guides the firm's investment manager research process?
Yeah, I think kind of the motto would be past performance is not an indicator of future results.
Said like a good compliance officer.
It starts from there, because I think if you're looking at performance, you're going to be led astray essentially. So it's how can we narrow down this universe into a workable list that we then go do deep dives in. And I think the problem is most people would start from kind of, let's do all these return metrics to screen it down and then work from there. But I think generally if you do that, you're starting from the wrong place, because now you have a list of funds that are likely to underperform and you're trying to see which ones, are going to then work going forward. So by making your screen, obviously you have to use some return metrics in it, but kind of when we narrow it down, it's 55% of our kind of score before we narrow it down would be return related metrics. And then 45% return metrics, but it's mainly, how can you quantify qualitative things? So what is that 55%? Well, obvious things, expense ratio is going to be in there, but low turnover, we think, that leads to. So it's all the small things that lead, and you're also look at things like about the firm. Well, how can you quantify the firm? It's usually kind of a qualitative thing, and so that would be more, well, what's the average turnover at the firm of managers. What's the 5-year turnover ratio at the manager level at the firm? Because that's going to also tell you, maybe it would be nice if there was an analyst, if there's an analyst, a stat for that, but that kind of tells you if there's disruption going on at the firm. And then also at the firm level, how many managers invest in their own funds? It's not necessarily about how much are they investing in the fund that you're going to invest in, but it's kind of a cultural thing. If all the managers are investing in their strategies, and it means it's a cultural thing. So it's all these metrics or success ratio at fund companies. What percentage of the funds at that company are outperforming? Because that says, are they just making a strategy to raise funds and make money, or are they actually, this is a specialty? Is this something that they're actually good at? So all of those sorts of things make up the 55%. And then on the returns-based thing, it's all just rolling. Last 10 years, it's rolling because no one, static time frame really matters, and it's all drawdowns and throw in all the metrics you can think of on a rolling measure, and that kind of gives us a starting point.
It sounds like with that 55%, you've really honed in on the art relative to the science. So really thinking about the qualitative attributes.
Yeah, and obviously you have to dive in much deeper after that, but at least that gives you a good starting point versus returns based.
So you're basically building a mosaic, right, on the underlying manager, qualitative, quantitative. You wear a few hats, right, as compliance officer as well as head of investments. Who else is supporting you on the investment side from a research standpoint?
Well, we are a smaller firm, so a lot of it does fall on me, but we do have two others that kind of work on executing the portfolios in our firm. So we got kind of two different departments. We got the advisory side and then the investment side. So there's three of us kind of on the investment side. But again, smaller firm, so I'll do most of the top level screening.
Got it. So you shared a good amount of the underwriting process already, kind of the 55%, that qualitative and typical screens. But maybe give our listeners a better understanding, right? Like, what does your process look like from a cold outreach, a manager you've never spoken to, and maybe the sense of timing around things, right? We understand the RA market is very dynamic, right? You all have the discretion to either move fast or move as slow as you would like. Give us an expectation of, right, you start the research process from implementation at the end of the day.
Probably for a lot of firms, it's amazingly long, they probably think, but sometimes it can happen quicker, and it'd be market conditions would kind of dictate that. But we do try and have, kind of funds on, we know that these are the funds we would use if something happened, if the manager changes on one of the strategies we're using, we have them back. But we've taken as long as, I think, couple of years ago, we moved to a fund that we had been looking at for 6 years, and we finally decided, okay, we think now is the time for that. But we've also been probably as short as 3 months. Yeah. It really varies, and ideas coming to us, I would say, don't be scared to email. You might not hear back all the time. I do try and say, thanks, or something like that, and know people got it. But those emails are probably being seen, unless it's not if it was an automated one, it might get caught in your junk or something like that. But it's probably coming through. I am seeing it. Just if I'm not, reaching out, then it probably just isn't, we're not needed right now, essentially.
So you touched a little bit on it, if you don't mind expanding kind of the answer to the question of what does a win look like, right? So you have different types of clients, whether it's those corporate plans or those individuals in the retirement stage. Is there an approved list or kind of a select list, or do you have models that are client A, B, C, aggressive to conservative? They just plug into the model. What is that ultimate that win for the manager at Paul Ried?
Yeah, we do have loose models. I would say it's more asset class based. So we'll generally, in each category, we'll generally be using 2 to 3 funds at any time, but only one's going in an individual's portfolio. The win would be, you're generally going to be replacing somebody that's probably in 50% of that model or something like that. It's definitely very individualized to the client, so we don't have models necessarily as far as they're stuck in those. It's more, someone might have 2 different funds.
Can you touch on vehicles? You touch on funds. Is that mutual funds, exchange traded funds, and then we can get into alternatives, or is there any more illiquid or liquid alternatives in the portfolio?
Yeah, we are primarily mutual funds and ETFs. Again, we have our client base is very retirement focused and not necessarily ultra high net worth. So liquidity is number one for us. So we're primarily mutual funds and ETFs. Primarily the ETFs are on the equity side and the taxable accounts, just for the tax benefits there. We're very much for active management. But we realized systematic active, I guess you could say, also on the ETF side. So be more multi-factor. So it's systematic, but anything that's not cap weighted, I guess you could say, is active.
Going back to Kahneman, he introduced prospect theory in the book, which suggests that people evaluate potential losses and gains differently. Arguably, people also evaluate liquidity differently and risk management. So how do you integrate that understanding as it relates to losses and gains, liquidity, when you are assessing your client's tolerance for these things, particularly in the context of the manager research process?
So I would say we're definitely focused on the more defensive side of things. But it's how the portfolio works together. So it's not like every piece has to be, kind of on the downside protection side of things. But again, it kind of comes back to the idea I was saying before. We look for broad mandates. If we're going to use active management, we think we should use them to their full extent. I think one of the big knocks against active management is mainly because you're tying one hand behind an active manager's back and they can't pull all the levers of being active, whether that's saying, oh, you can't step out of your market cap range. You're going too much value. What is value? You can't buy this international company, even though because they're a competitor with U.S., but you're a U.S. only strategy. By allowing the manager to be more flexible, I think that naturally also gives the downside protection just through flexibility you're giving the manager. You're allowing them to get out of areas they think might be a little bit.
Are you doing the same thing in fixed income?
Yeah, fixed income is definitely a different story there. But yeah, I think you need to know what you're using fixed income for. And I know a lot of people, because high quality bonds have gotten so hurt in this rising interest rate environments, people are losing sight of that because lower quality is kind of relatively outperformed. But we are putting bonds in to be bonds, but we also give all of our managers flexibility. So that when we're talking about flexibility, we also don't like constraining those managers. So we may at some point say, like 2 years ago, might say, well, we want to limit your duration you can put on the portfolio, but we want to give you flexibility on all the types of bonds that you can buy. So you can go high quality, you can go to bank loans, you can go to high yield, you can be a multi-sector manager. We just want you to limit that. So sometimes we'll make broad-based limits on their flexibility, but for the most part, we try and give each manager broad flexibility.
Well, we don't curse on the podcast, but we do use 4-letter words, and one of them is fees. So when you're thinking about that balance between active and passive that you were mentioning before, arguably the big challenge is fees, right? So you want to give the active manager the discretion to go where they want. Maybe that one hand is behind the back. But on the other side with your clients, they're looking at that total expense ratio. So how do you strike that balance as it relates to fees?
Yeah, that is, it's interesting, even though it probably doesn't take all that much more work for some of these flexibility these managers are getting. Sometimes, they want to charge extra for that, even though it's not taking them more work to necessarily do. So yeah, the more broad mandates get, sometimes the expense ratios can creep up. So that's definitely on the radar, and is why also we do use, in some places, more ETF-based, multi-factor. If we think, because we think you can somewhat replicate that active idea with some of these multi-factor strategies. So fees are the biggest predictor of future returns. So that's basically why when I talk about that 55% of this initial screening score, it's on the fees, because that goes to the bottom line. And so that's always I guess you could say, a weighing factor when we're integrating these proposals.
Okay, so fees are the canary in the coal mine.
Yes, which is why when you get into the private area, and maybe we'll talk about this later, is why some of the hesitation, I guess you could say.
That makes sense, and actually, I think that leads you.
We can go right into that. I was going to segue from fees into the private markets. It's a little bit of a higher fee. There is some justification around it in certain asset classes, but take a step back. Just broadly speaking, private market exposure, is that an area you all are investing in? And if so, are you doing it directly yourself, or do you use an outside platform?
Yeah. So currently we have no privates in our strategies, but it is something we're watching closely, and I do like kind of the developments that are happening as far as interval structures. It's kind of that bridge between the two. I've seen a lot. It's really been good to see kind of real estate move that way. It's probably the more ideal structure for it. So it's something that we're looking at, and I think, the next 5 years, I think we're going to see a lot of innovation in what people are doing with the interval structure. But at this point, that innovation hasn't quite came there. And I think the one other lever will go back to fees. I think especially in the interval structure, because it's kind of a fund to fund most of the time structure, unless you're a private credit or something like that, is coming back to how does that first layer fee? I think again, management companies are trying to extract a little bit too much from some of those interval funds. So I do think fees will come down a little bit on that layer, and innovation will kind of come through the next 5 years.
Interesting. So moving maybe back from private markets, since there's no exposure today. So as you think about the opportunities that you're seeing today in the public market side, specifically with equities, maybe to start, what are some of the areas that you're spending a little bit more time from a research perspective?
In the global space, definitely focusing, maybe global value. So a manager, again, we don't constrain managers, but naturally as a manager, you're either a growth manager or a value manager. It's kind of like your mentality. So we are looking for more global managers. And this is kind of one of my pet peeves, though, is the industry, the way that they make funds, especially in the U.S. We got U.S., we got developed international, we got emerging. We're going to give you our style, but we're only going to give it to you in these little silos. And I don't know what the hesitation is of everyone just releasing your fund in a global strategy in the U.S. In the U.S., particularly, every manager I go to, I kind of say this, so I'm saying it here to get it out, hopefully to everyone, is your competition also is much higher when you do it in the silos, because everyone launches a U.S. only fund. Everyone launches a developed only fund. And there's actually more emerging market only ETFs than there are global ETFs on the marketplace. So definitely, if you look at developed markets only ETFs versus global ETFs, they do say it's the RIA's fault, because they say that we allocate that way. And so, but I think it's also about education. So you need to educate about the tax advantage. You want to talk about tax advantages of ETFs and things like that. But if you have the pieces, you have to rebalance the individual pieces causing tax problems. Whereas if you put it in a global strategy, it's all happening within the wrapper. And so it's actually the most tax efficient way that you could offer a strategy.
So will you go as far then as multi-asset class solutions?
Yeah, we do. I think as far as, multi-asset class would be very tax efficient in like ETF sort of wrapper. Not that many are necessarily out there.
That's what I was thinking. You're talking about a small universe to dip into.
Yeah, exactly. So it's a little bit more complex, just also because one firm isn't usually a specialist in each of those areas. So then they're like, well, whose other competitor's product are we going to buy to put in there? And that kind of comes in. So we don't really use those, but we do use multi-asset class funds, and we know they can be a little bit less tax efficient, but again, we like providing flexibility. So when we talk about alternatives, a lot of times people will talk about, whether it's futures or something like that. When we have an area we call dynamic alternative, which can include things like that, but most of it's actually just giving a manager full flexibility because we set the kind of the tactical, the structural long-term allocation, but getting those deviations and overweights, we find managers that have full flexibility on the asset classes, and they're essentially two different managers that we have in that place. And together, they're giving the big overweights and underweights, whether it's U.S. international bonds, or they can add alternatives as well. So that's kind of how we look at that.
You touch on the public markets, global and global value. What about on the fixed income side? Any areas of interest or needs, if you will? Yeah,
that's the most interesting part. We've kind of been staying. We're not going ultra short or anything like that, but we have shorter duration, probably 3 to 4 or so right now. The biggest thing on our radar would be at what point, which everyone's probably talking about right now, what point do you extend that? You can't be short forever, but with the yield curve that this inverted, it's definitely not tempting to really extend it much, all that much longer. I think the upside of, meaning if things hit the fan, the yield's going down, I don't think you're getting that much of a boost versus the risk that you're taking. So we're fine staying kind of short now, but we're queuing up a fund for when we want to kind of extend that duration.
Just from a research standpoint, obviously being at your desk, right, whether it's working from home or in the office, getting inbounds from managers, maybe flip it. What do you do from an outbound standpoint? Are you attending conferences? Are you meeting with other colleagues or other peers within the Seattle area? What does that look like from a travel standpoint, going out there to go find and meet with managers?
Yeah, I think conferences are kind of underrated. I think people always say, "Oh, I go to a conference," or how much? But I think you really are, and it's the in-person one. That's what it is. It's like if you just attend a virtual thing, you're just literally watching that session, and there's no conversations after. But it's about those conversations in between, getting ideas from whether it be peers or people that, sponsors that are at the conferences. You definitely might get exposed to something you might not otherwise see. So I would say conferences primarily and peers that
Are you going on site to meet with managers ever?
Yeah, we do. It's kind of obviously been less. I haven't really got back into the full flow of that. Hopefully meet with some actually after this. So definitely when you travel, you try and find out who's in what area and be able to fit in some meetings there. So definitely do it, but less than we have.
Well, it sounds like for managers, it's a very good reason to get out to Washington. So thank you for sharing all that. It's helpful. I can't help myself because I know this is going to be an easy edit for me because you are a chief compliance officer as well. So I know you're very careful with your words. You've passed a lot of series registrations, so it makes it easy for us. But would you mind, just for our audience, because I'm curious, and I know our audience, particularly those who work on the operations side, can you tell us a bit about your responsibilities as it relates to your C2C CCO?
Yeah, so this is kind of a role that I took on when we converted to full-on RIA about 5 years ago. The firm had been working through a broker-dealer, in their RIA, on their RIA side for the advisory accounts. I was really pushing for flexibility of the types of investments, whether it be shared classes or whatnot, as well as just the whole client experience and the technology you're offering. Because again, sticking with a portfolio is more than just the portfolio itself. It's the way they can access information. It's the information you can provide, how you provide it. So flexibility on technology was really important. So I really pushed for us making the transition to that. And so he said, okay, we're on board with that, but you kind of have to lead the charge and do the research for breaking away. And so obviously, we do work with another firm, NRS, to help with the compliance side of things, but you need someone in-house to actually someone actually has to take on the full-on responsibility. You can't outsource responsibility. So I decided, I'd definitely be willing to take that on, and it's definitely been a busy regulatory changing environment, lots of changes, but it's the necessary part of the business to keep it going. So, and I definitely have another fellow in the office that really helps me with all the compliance legwork that goes into that.
So from what you've seen, what do you see as some of the bigger challenges that RIAs face from a regulatory or a compliance perspective?
I really think it's just the pace that they're coming out with all these regulations and changes. It's keeping on top of them, and they roll it out so fast, and there's so many ways to interpret what they're saying. You then have to wait for them to come out and say, come out with the FAQ of clarifying what they actually meant by that. So I think the biggest challenge is just keeping up with it, and then after it's interpreted, how do you implement that to your specific business? Because that's a whole other story. If you're smaller, it helps because you know exactly how everyone's doing it. If you're kind of a bigger organization, you have to realize every advisor does things differently, and you might have to have different sorts of policies to cover that.
Well, one area that regulators have been thinking about and investors had been looking at for many years is ESG, environmental, social, and governance investing. So from your perspective, from your client's perspective, has ESG been part of your thought process as it relates to manager research, or even just as an input into how you're thinking about opportunities?
Yeah, it's not necessarily, we're not necessarily ESG investors at all, but also the pushback on it recently, I think it's been somewhat surprising in a way. Not necessarily, I see the points being made, but at the same time, what the way we look at it, the way we always thought about ESG is how does it integrate with the financial side of things. So from the factors, the ESG factors that are actually financially relevant, but I think managers have always been looking like that. So, but when ESG kind of became more popular, every manager had to say something that they had been doing already and are basically now calling that it's ESG. So I bring it back to when clients maybe bring it up. I also mention, well, you do want your manager to take into account that, a deep sea driller, is exposed to the financial risk of oil spill, or the companies that, might work with forever chemicals. That's obviously become, a financial. So if you don't at least price in that risk, you don't need to avoid the company. But if your manager is not at least pricing in that risk, then, wouldn't you want that? If you're investing your dollars with them, I think that would be a factor you'd want, whether you, agree with all the ESG factors and maybe some of the non-financially relevant ESG factors, then that's another story.
Makes sense. Thoughtful.
So it's totally separate, but unfortunately sometimes lumped together ESG and then diversity, equity, inclusion, and some emerging managers. For our listeners and ourselves at Dakota, we do have kind of smaller, newer funds that we're out there raising capital for. Can you touch on the use of emerging managers, maybe some of those smaller, newer funds? Is there an opportunity? Because you did touch on the top of the call, rolling returns, right? And being able to screen some performance metrics. But what about a manager that's, I don't know, maybe a couple $100 million, 3-5 year performance? What does that look like from a utilization standpoint?
And so when we have the longer screens, again, if someone doesn't meet that, all that it really does on that score is just move the weight of everything else higher. So all the non-return related things become more important. But again, that's just a tool. But we obviously look at funds that aren't meeting that and are new and have something innovative. So I think the bigger challenge would be emerging managers in areas that are already well-defined and heavily populated with other managers. But if you're coming out with a truly distinct strategy that's differentiated enough, then we are going to consider them if they're filling kind of that need that you have. We're not going to disregard it because that's maybe what we're looking for. And it used to be something even in, think about, I'm thinking maybe 10, 15 years ago, looking for a multi-sector short-term bond fund was actually harder than it is now. And so you needed less of a track record to come out with that. That would be more appealing, and we're going to look at it without a long track record.
Well, you shared some of the areas that you're focused on. We were talking about equities and fixed income, but just curious, I'm sure you get this question from a lot of your clients, just how do you see the global economy over the next few years?
Yeah, bring out the crystal ball. No.
I saved this till the end to give you plenty of time.
No. The consensus has been changing to the no recession. It seems like very, very quickly moved to that. But it's interesting because I think it's moving to that, even though I think the data is pointing to it actually getting closer. Like my whole counter to the recession was just employment was way too strong to ever, like when we had two negative quarters of GDP last year, I was like, well, you can't really call it a recession though, because employment's way too strong to call that a recession. But now I don't think that's necessarily the case. So we might have, I definitely think jobs are weakening, but maybe we get something that's the opposite of last year, where we get poor jobs with actually positive GDP, and then do you call that a recession? I think you could have maybe a recession that doesn't get two negative quarters of GDP or something like that. I think if you look at the Fed forecast, for instance, you have big divergence. You have one saying, I think it's the Atlanta Fed's, that's at 5% or 4.9% for this quarter. And then you have, I believe it's the New York Fed or one of the others that's actually at 0 or something like it. Might have been revised up since then, but from 5 to 0, even the Fed own forecasters can't get this right. So definitely I wouldn't necessarily listen to my projection for the next year, but I think we're definitely going to have some slowing.
That's helpful. Thank you so much. Looking forward, another question I'm sure you get are the main challenges and opportunities that you foresee in the investment management industry. So another way that we hear often is what keeps you up at night besides boring financial books?
Yeah. What keeps me up at night? I think it's mainly kind of clients' interpretation of returns, maybe, because I do think too, it's about sticking to the plan and knowing. Again, it's always about sticking to the plan, but you can get really worn down when you have negative bond returns this year. Rates have been rising again. You're like, well, remember, it's going to mature. Bonds have a set maturity date. You're going to get, but it's kind of educating on how these asset classes work and expectations. 'Cause I also think it's kind of interesting that a lot of times, what you hear from clients is bonds are confusing, but stocks aren't. And I don't. Even though to me it seems like it should be the other way around, because bonds are defined. You know what you're going to get. You know what date you're going to get it, and
it's a contract.
Yeah. Whereas stocks are more we feel like paying 20 times earnings this year, and now we feel like paying 15 times earnings. So what keeps me up at night is mainly, clients' views of returns. Because also you look at, S&P 500 cap weighted up double digits, even though the equal weighted just went negative a couple of days ago. It's a huge divergence. And so it's just education about returns, about long-term returns. But if you're talking about, market-wise, it's mainly the things that affect those returns are keeping me up at night. We
always like to end the show by asking our guests, the people who really helped you along the way, who's influenced your career in terms of mentors. It can be a person, it can be an event, it could be maybe a person who wasn't so helpful and you learned a lot from that. So we'd love to hear from you.
Yeah, well, I would say, one thing we haven't really talked about, so I would say, Paul Ried has definitely been a huge mentor and, the best financial advisor I know, and we have not mentioned also my dad. So he has been a great mentor, and obviously, different last names. He's my stepdad, but, kind of came in my life, kind of later elementary years. So I don't necessarily use the term dad for him. Still, it's kind of Paul, but he truly has been that father figure. And truly, taught me a lot about, putting clients first, about, growing up kind of before he got into the, financial industry. You might think of, kind of the other side of, Wolf of Wall Street sort of side of finance. And he's been, showing you that there's truly another side that's the true polar opposite of that, and putting clients first. And so I would say he's definitely been my mentor.
Well, we're grateful to the two Pauls.
Yeah.
Thank you for being here. Congratulations on all your success. This was a very interesting conversation for us. So thank you for coming to Philadelphia.
Thanks for having me. Thank you both.
Thank you.
If you want to learn more about Adam and Paul Ried Financial, please visit their website at paulried.com. You can find this episode and past episodes on Apple, Spotify, Google, or your favorite podcast platform. We are also available on YouTube if you prefer to watch watch while you listen. If you'd like to catch up on past episodes, check out our website at dakota.com. Finally, if you like what you're seeing and hearing, please be sure to like, follow, and share these episodes. We welcome your feedback as well. Adam, thank you for joining us. Tim, as always, it's a pleasure. And thank you to our audience for joining us at Dakota.
Don't say goodbye.